Most banks I meet are spending 90 cents of every technology dollar just keeping the lights on. Hi, everyone. Welcome back to Next Move Banking. I'm Virginia Heyburn, Principal Strategist with Engage FI. Last week, I closed out 5 predictions about where the core banking market is going. And I said the institutions that fall behind won't be the ones that couldn't hire the talent, they'll be the ones that waited. The question is whether your institution could start tomorrow if it decided to. And most banks I talk to genuinely don't know. Not because they haven't thought about it, because nobody's ever measured it. If I were sitting with your board this afternoon, here are the 5 questions I would ask. Together, they show you where your institution is constrained. Score each one of these, 0 if the answer is no, 1 if it's partial, 2 if you could prove it to your examiners and your customers. First, access. Can your institution reach and use its own data in an environment you control without economic barriers that discourage innovation? If the answer is no, then everything else waits. Second, learning. When one of your systems makes a decision, it could be a fraud flag, a pricing recommendation, does the outcome ever come back and improve the next one? Or does every system make the same decision today that it would have made a year ago? If nothing in your institution improves on its own, that is not a failure. It's the starting line. It's just worth knowing that you're standing on it. Third is speed. When something important happens anywhere in your bank, a customer's balance moves, fraud starts, a deposit relationship begins to slip, can you respond while it's happening, or do you find out tomorrow morning in a report? Fourth is economics. Do you know what it costs to produce an AI-supported decision? Not the software expense, not the cloud invoice, your cost per decision. And it's a harder number than it looks because it's scattered. A single decision could touch your model provider, your cloud, a data access fee from your core, and it might do that several times before it produces an answer. Those charges could arrive on different invoices in different months, owned by different people, makes it very convoluted. So the question underneath this one is whether anybody in your institution is pulling those numbers together, because if you can't measure it, you cannot govern it. And fifth, capacity. Every institution talks about innovation. Very few move real dollars out of maintaining yesterday's technology and into building tomorrow's. So put a number on it. What percentage of your technology budget goes to keeping what you already have running? For most institutions I see, it's around 90%. I said that before, 90 cents of every technology dollar spent keeping the lights on, and a dime left over to change anything. It's been like that forever. You cannot build a future on a dime. The market is changing. It's changing quickly. So let me put a stake in the ground. That number has to get closer to 60%. Not overnight, of course, but get on a path with dates against it and someone accountable at the board level. Because until it moves, every strategy conversation you have is theoretical. You're planning with money you've already spent. It's 2 if you know that percentage and it's closer to 80, 1 if you know the percentage but it's hovering around 90, and 0 if nobody in the building has ever calculated it. Now the important part. Don't add the scores together. This is not a maturity model. It's a dependency model. And 1 0 affects everything above it. Access and capacity on either side of the floor. Without your data, nothing above it works. Without money freed up, nothing above it gets built. Learning, speed, and economics all sit on that floor, and none of them can rise higher than the floor. So your lowest score tells you where to begin, and each one points somewhere different. Access lives in your contract, which makes the renewal your best moment, although an amendment can work too if you can't wait that long. Capacity lives in the budget, and that's a board decision. Learning and speed live in your architecture and your vendor choices. Economics lives with whoever owns technology planning, and right now, the cost of decision is usually unknown in our industry. But they aren't separate projects. You can't negotiate a contract well without knowing what you intend to build, and you can't build what your contract doesn't allow. So the strategy sets the direction. The tactics either preserve it or quietly give it away. And not one of those 5 questions asked how many data scientists you employ. That is not the most important question to ask. So run this as a board agenda item with a name and a date against your lowest score. And be careful of the uncomfortable and comfortable answer. Most institutions want to start where the work is easiest. The scorecard exists to tell you where the work is necessary. Because notice what these 5 questions never asked. Not one of them asks what you plan to do. They all ask what your institution is currently able to do. And those are really different conversations. Most strategy documents I read describe the first and quietly assume the second, which is why I would pair this with one other exercise. Write down your vision for what your institution should be able to do in 5 years. Not a technology roadmap. This is a vision. What decisions do you want to make better? What your customers could experience better? What your people should be freed from so that they can focus on more strategic work? Then put the scorecard next to it. Your architecture, your contracts, your data terms, your budget. Every one of those either serves that vision or it constrains it. That's the series. 8 episodes, 5 predictions, and 1 scorecard you can put in front of your board on Monday. Tell me where you land, and if the answers point somewhere uncomfortable, those are exactly the conversations we have every day at Engage FI. Thank you for spending this series with me. I'm Virginia Heyburn, and that's your next move.